Welcome to the Hodge and Law PC International Tax Lunch. We do this at noon Pacific time, the third Friday of every month. My apologies to you if you are in Europe and you have to stay up late to do this, because it's Friday night and you should be having fun. If you don't catch this live, like right now, we put it back onto YouTube later so you can watch it at your leisure. You don't get bonus points for that, but it might be fun. Anyway, this month is going to be a guide to Global Intangible Low-Taxed Income. So this is an overview course. This is a simple course. This is designed in an hour to sort of give you the lay of the land. So this abomination was dropped on us in late 2017, completely upended the way that controlled foreign corporations were taxed. And it's hard to wrap your head around it because there's a lot of gratuitous complexity. So, just like all the best movies in the world have senseless violence and gratuitous nudity, here we've got the gratuitous complexity in tax code. So let's live with it and have fun and enjoy it and mock it as we go along. So just to make it clear what I think about global intangible low-taxed income, here's a quote from Stephen King, and you can see how many adjectives the Internal Revenue Service or our friends in Congress have larded in front of the noun, which tells you about how close to hell this tax provision is. The table of contents, this is where we're going to go. I'm going to introduce you to a few big ideas here just up front to orient you. Who cares about this, and some basic ideas that will help you make sense of where this planet fits in the solar system. And then we'll dive into the forms that are used to compute global intangible low-taxed income. And that number then is dropped on your client, the taxpayer's personal Form 1040 in this example. I'm going to just give the example of an individual who owns 100% of a controlled foreign corporation. And what does this look like? A companion sample income tax return came to you by way of PDF, so you can see how it all works and how the numbers actually flow on the 1040 at the end. But this is how we're going to go. So starting at section 3 all the way to the end, we're going to be looking at the forms and following some numbers as they trickle through the forms. First things first, who cares about this? The only people that care are people who are United States shareholders, defined word, of a controlled foreign corporation, defined phrase. So these jargon alerts. Controlled foreign corporation, if you're in international tax land, you know how this works. You look at people who are US shareholders, which we'll define on the next slide, and you add up all the stock that they own in the corporation, and if it's more than 50%, so 50% plus a share, then the corporation is a controlled foreign corporation. If it's under 50%, nah. And the fun happens with attribution rules, constructive ownership, and all that fun stuff, which incidentally is the topic of next month's presentation. A U.S. shareholder is just someone who has 10% or more of the stock of this foreign corporation by voter value. And of course, it's a simple thing, and there's layers of complexity beneath it. But that's the general idea. You're looking at 10% plus shareholders. So these are the only people. So in my example here, we have a US shareholder because we, by assumption, assume that this person owns 100% of the issued and outstanding stock of a foreign corporation. So the foreign corporation is a controlled foreign corporation, and this taxpayer that you're doing the income tax return for is a US shareholder. And here's my little handy dandy summary. In general, I'm going to give you, where appropriate, quotes from the code or quotes from the regs. Not so much that I want to read this stuff to you, but your slide deck that you have as a PDF on your hard drive is going to sort of be better, you look back at the slides and say, what the hell was that about, if you have a simple bullet point? And hopefully I've given you enough context so the slide deck as it stands all by itself will be self-explanatory. So hence, in the general sense, I don't like slides with just walls of text. Back to the story here. So this is the quick summary that you can see. When will Section 951 Cap A, Global Intangible Low-Taxed Income, apply to the taxpayer? And in a second, we'll talk about the implications of it. So from the left column, first things first, you look at the foreign entity and you say, is this classified as a corporation for U.S. income tax, well, tax purposes generally? And the general default classification is, if all of the owners of this entity have limited liability, this is an association taxable as a corporation for U.S. tax purposes. You might be able to make a check the box election to make a difference, but that's the default classification. So let's assume it's classified as a corporation for U.S. tax purposes. The next thing is it a CFC? In other words, do U.S. shareholders own more than 50% of the stock? And that top line, yes, we assume that's true. And then the next thing is we're looking at your client, the taxpayer, and say, is your client, the taxpayer, a U.S. shareholder holding 10% or more? Yes. If so, then Section 951 Cap A applies to the taxpayer, and you're going to have some kind of gross income inclusion on that Form 1040 you're preparing. You can see under all of the other scenarios, there is something missing. And that something missing means you don't even have to worry about Section 951 Cap A, Global Intangible Low-Taxed Income, passing through to the Form 1040. So on the second row down, we say, yeah, this corporation is a controlled foreign corporation, but your shareholder doesn't own 10%, like it might be a 5% shareholder. In that case, you don't have to worry about the corporation's net profits being pushed through to the individual's Form 1040. On the third row down, we have both, it is both true that the corporation is not a CFC, and the taxpayer, your client, is not a U.S. shareholder. So for whatever reason, we've looked at all of the stockholders of the corporation, and we've decided that less than 50% or less is owned by U.S. shareholders. So again, we don't care. And of course, if the entity is not a corporation, then you don't worry about Section 951 Cap A at all, because it only applies to controlled foreign corporations. And this gives you a marked clue that if you decide that Form 5471 and Global Intangible Low-Taxed Income inclusions are just a giant PITA, you might think about doing a disregarded entity election for this thing, making it a disregarded entity, and therefore you don't have to worry about doing 5471 ever again. Instead, you do a Form 8858. And I'm just going to tell you that I'm in 2/3 of the way through doing some calculations for a structure in Europe, and by making disregarded entity elections for its 18 or 19 subsidiaries, we've cut the estimated tax cost in the United States from about 30 million a year to about 10 million a year. So I encourage you that if you have things like this, look very carefully at making disregarded entity elections, or making an election to make a multi-shareholder foreign corporation be classified as a partnership. You might get much better tax results here in the United States, and you might make the paperwork a lot simpler. Anyway, that's an aside. Let's go. These are two big ideas I just want to keep in mind as we're going through, so that you'll know what's happening here. And the first one is that Internal Revenue Code Section 951 and this new category, relatively new at this point, category of income called Global Intangible Low-Taxed Income, is just a way to override Subchapter C, because the default method of operation in the code is that a corporation, whether it's foreign or domestic, you do all your computations and you use all the concepts of Subchapter C to figure out what happens to the corporation, how its income is calculated, how its shareholders are treated, blah, 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 unless you find an exception. And the classic exception in the good old days was Subpart F, and that was the only thing where the Internal Revenue Code had drilled a hole in the bottom of the good ship, Subchapter C, to just shoot income straight through to the shareholder. And now we have a new one. We put two holes in the boat, which largely makes a foreign corporation a pass-through entity, but not quite at this point. So just think Subchapter C in your head for all purposes, unless Subpart F applies, but we're not talking about Subpart F today, except peripherally, or this calculation that we're about to do under 951 Cap A exists. And this is why when I say, you've got Subpart F applying, you've got Global Intangible Low-Taxed Income, if most of that results in a functional pass-through of net profit at the corporate level to the individual shareholders' income tax return, why not go all the way and just make the disregarded entity election? Okay, so that's the first thing. It's as close, like you get pretty close to pass through, except with lots of extra paperwork. The second one is the computation is baroque in its complexity, but it's a simple subtraction game. You start with a number, you drop down a level, you subtract some stuff, and they tell you what to do and what to subtract, and you end up with a result. And then you drop down again, you subtract some more stuff, and you end up with another result. And then you drop down again, and you subtract even more stuff, and that's what your gross income is. So we're going to, for the rest of this presentation, walk slowly through this slide where we start at the top with gross income, and we slowly subtract this, that, and the other until we end up at the bottom with the number that is defined in the code as Global Intangible Low-Taxed Income and is included in the taxpayer's income tax return because of Section 951 Cap A, open parentheses, little a, close parentheses. And you can see that the number that's Global Intangible Low-Taxed Income, which is computed on Form 8992, drops straight over to the shareholder's income tax return. And then I give you the cross-reference for a corporate return. So if you have a domestic corporation owning the CFC, it goes to Schedule C, line 17. If you have an individual shareholder, which is what the game we're playing today, it goes to Schedule 1 of Form 1040. And then from there, sums with everything else happening on Schedule 1 and then drops onto Form 1040 so you can calculate tax liability. All right, so let's start at the top with gross income. Here's my super duper simple example for what we're going to do today, just $20,000 of income, gross revenue, and we have two simple items of deduction expenses. One is depreciation, so this little tiny corporation has some assets and they're depreciable, and interest expense to some random third-party lender. So we start at the top and we say, okay, we've got to figure out the controlled foreign corporation's gross income. Now, this is a game that you have to play for any controlled foreign corporation, whether you're looking at Global Intangible Low-Taxed Income or you're looking at Subpart F income or you're looking at anything. How do you define a controlled foreign corporation's gross income? And this is a kind of weird little conceptual thing the first time you start playing in international tax land. You say, geez, I've got a bunch of US tax principles going on, but I've got a corporation in a foreign country and it has its own accounting principles and its own tax laws and whatnot. What do I do? If you have a depreciable asset inside a foreign corporation and that country's tax laws have a certain depreciation schedule that's different from the Internal Revenue Code, what do you do? So here we're going to answer it. The general rule is that you treat a controlled foreign corporation just like a domestic corporation. So we don't even care what's happening in the foreign country. We don't care about its, accounting principles, as tax laws or anything, you're going, for computing these tax results here, you're going to treat this as a domestic C corporation. And again, I'm just putting these citations, and you can go look them up and read the whole thing at your leisure, but that's the general operating principle. And so let's start with, this is the first page that we come to of the tax form, and we're going to be marching down it one line at a time. I've made a simplifying assumption here. Whenever you have a foreign corporation, you have to figure out what's its functional currency. What's it doing business in? What kind of currency? And I've arbitrarily decided to declare that the functional currency of this controlled foreign corporation is the US dollar, just to make the form simpler. Because if I said it's euros, then you'd have to add an additional computation module in your brain to follow along in the example to compute, well, what's the exchange rate? When do I calculate the exchange rate and all that stuff? So we've just abstracted away all of that noise in your head for exchange rate fluctuation. So if you don't like the idea that we've got a foreign corporation with a functional currency of a dollar, US dollar, just pretend this is a Bahamian corporation and it's a Bahamian dollar, and the exchange rate is a fixed 1-to-1, the same result. So anyway, that's an aside. Throughout here, functional currency of baht. So there you are. We have our $20,000 of revenue at number one, gross revenue, all sources, all kinds of fun stuff. Now we come into the complexity. And for those of you who have done 5471s before, and specifically have learned to love subpart F, you know that you're going to do the computation of subpart F income, which is included in the shareholders' gross income for personal income tax purposes. You're going to do that calculation of subpart F income at the corporate level. Global Intangible Low-Taxed Income is not, you don't compute the net profit that's going to be ultimately included in the shareholders' personal income tax return. You don't compute it at the corporate level, you compute it at the shareholder level. So you're going to see a little bit of functional difference. And this is an example of gratuitous complexity in the Internal Revenue Code. Why have one system for calculating an inclusion number when you can have two? So here we've dropped down to the second line, and the bright red thing shows you the topic that we're going to be discussing. So we're talking about gross income exclusions. So we're looking at gross income of the foreign corporation, the CFC, and we're saying, of all these dollars of gross income that are earned by the controlled foreign corporation, let's put a tag on them for different types of income. And you'll see here at line 2 on Schedule I-1, the exclusions, A through E. So A is effectively connected income, B is subpart F income, blah, blah, blah. The big takeaway for you to understand here is that these 5 exclusions are different kinds of income where the Internal Revenue Code already has a cunning plan for how these things should be treated and how they should be taxed. So, example, line 2A, effectively connected income. Not part of this topic today, but if you have a controlled foreign corporation that is actively engaged in business in the United States, boots on the ground, manufacturing, whatever, and is generating a profit, that net profit is effectively connected income, and the corporation itself is required to file Form 1120-F and pay corporate income tax at 21% on that effectively connected income. So it's excluded because if you're going to be calculating how much of the CFC's income is going to be taxed to the shareholder, you don't want to double tax it, because if you have $10 of effectively connected income, why tax it on Form 1120-F and then drop it down to the shareholders Form 1040 as well and tax it again? So that's the reason for the exclusion. Subpart F income is the same. The Lord has a plan for Subpart F income. It's immediately pushed through to the shareholders' income tax return and included in gross income. So we want to subtract it from potentially being included in Global Intangible Low-Taxed Income. So that's an example of why these things exist. It's to make sure that a dollar of net profit at the end of everything is only taxed once, either at the foreign corporate level, my example, effectively connected income, or at the shareholder level, example, Subpart F income, or example, Global Intangible Low-Taxed Income. So that's why these things exist. Now, here is the list of the 5 and the cross-reference to the code from whence they come. And I was having a conversation with a good friend of mine, hat tip to Ann Lewis. I don't know if you're on the call today, Ann. And she's a CPA licensed in New York and California. And she was saying, yeah, I don't like these webcasts that lawyers give, and they just give references to code sections. And I was thinking as Ann was saying that in my head, I was thinking of this slide and saying, oh, pooh, I just put my foot in it, didn't I? And it's a fair comment, and I promise that in future episodes of presentations for Global Intangible Low-Taxed Income, I'm not going to make this mistake again. Because really what I've done here is like you saying to me, hey, I want to cook dinner, and I throw a cookbook at you and say, go to it, right? That's not very helpful at all for me, so I'm sorry. So anyway, too short to talk about all of these things now. Side note, this is an intro. I never know how deep to go, but for instance, you could spend a lot of time on these, like, 20 minutes, just talking through, making sure you understand how they connect and how they go out. So example, effectively connected income. You subtract that out of Global Intangible Low-Taxed Income, but now you're going to throw it on a Form 1120-F. Well, what does that mean? And what is it? Is that a good thing or not? And collateral damages, branch profits tax. So there's all sorts of hidden depth in all of this. And I would like you, if you would, email me and tell me what topics are interesting for hypernerd territory, because I don't know how much demand is out there for hypernerd territory, upper tier, complicated stuff, and how much demand is out there for basics, just orient you in this new world. You've landed on a new planet 951 Cap A, and you don't know where you are and what to do next. So anyway, enough of that. Those are your things, but just so you know all the possible types of income that you're going to have for a CFC, it's these 5 exclusions, and then the remainder after you take all of these things away is what's ultimately going to drop on the tax return, the Global Intangible Low-Taxed Income. But it's also possible that you can have regular old corporate income with earnings and profits, just like schedule, Subchapter C says it should be. And at that point, you've got that to contend with. And the reason this is important is because when you later make distributions from this CFC, cash money upstream, you have to figure out, is this a dividend? Is this a return of capital? Is this capital gain? Section 959 says if it's previously taxed earnings and profits, you can pull it out without any tax. But if it's not previously taxed earnings and profits, it can be treated like a dividend. These are important things. And just so you know that the overlap of Subpart F income and Global Intangible Low-Taxed Income almost, but not quite, eliminates the possibility of untaxed earnings and profits that will generate a dividend later. And again, if that's of interest to you, that's a whole hour plus or whatever. And please tell me, does the market want that kind of stuff? You being the market. All right, we've come to decide what the 5 exclusions are for your particular CFC, and we've subtracted them. And the result of that subtraction is a thing called gross tested income. And the code doesn't call it gross tested income, but the regulations do. So I'm going to use that phrase because it's useful. Oddly enough, the result after you subtract expenses from gross tested income is not net tested income as God intended it to be, and it would be clean and simple and easier to understand. But I'm not bitter about that. Anyway, so what you've got is you've deducted your exclusions and you've got gross tested income, and that is a number that shows up on Schedule I-1 at line 4. So in our example, we didn't have any kind of exclusions by assumption. So gross tested income is going to be 20,000 again. Next, we're going to subtract allocated expenses and taxes that's attributable to this category of income. And this requires, if you had multiple categories of income, which you would see on line 2A through 2F through E, the 5 different categories, you would have to do an allocation and apportionment game. And I'll do a hat tip towards that as part of this little sequence, but we don't have any by assumption because that would make the example way more complicated. So we're going to look now at the expenses of the CFC that were incurred in generating the gross tested income. And so specifically expenses and corporate income taxes allocable to that gross tested income. Oops, there we go. And here it is. You can see on line 5, here are the deductions. And my assumptions were depreciation on the assets of $2,000 and interest expense of $1,000. So you stick them both on line 5. And if you want to cross-reference, we'll talk about that. You can look at the balance sheet of the Form 5471 Schedule F, and you can see what's happening with the assets and the depreciation. But line 5 is where it's at, and this is the number. And in our case, all of the income is global intangible low-taxed income, so we don't have to do any allocation and apportionment of expenses between, for instance, Subpart F income and global intangible income, because we have all global intangible low-taxed income. Again, going back to the sort of metaphysical question, I've got a foreign corporation doing business under foreign law and foreign tax law and all of that. What kind of deductions can I take? And the short answer is, again, pretend the CFC is a domestic corporation. Look at allowable deductions under the Internal Revenue Code. Same as if you had a California corporation manufacturing widgets. What can you deduct? Same rules. That's what's allowable. And then you use the normal conceptual idea of allocation and apportionment of deductible expenses and taxes in the same conceptual framework that you use for everything, which is if you can tag an expense or a tax directly to one category of income or another, you do that and you allocate it that way. And after that, if you just got a free-floating expense, let's say a filing fee to keep the corporation in good standing every year, you're going to do an apportionment, a weighted apportionment amongst the different categories of income that you have. And the result of doing that, subtracting the expenses and allocable taxes, will be the thing called tested income. And this is a fun thing, and this is the one that you really care about, because it's the next to last step before you come to the actual global intangible low-taxed income that's going to drop on your personal income tax return, and you're going to have to pay real income tax on that, whether or not the CFC actually distributed any money to you, so you could pay the tax. So the calculation you see is on line 6, same slide as before. So we've got 17,000 of tested income. So you can see in a real sense, this is like true, no BS accounting income. You know, gross income minus real expenses, and you're ready to rip. So that's what we've got. And the other interesting thing to see here, not that it's important for our example today, but look at line 6. Line 6 is the first time that you have to convert from functional currency into US dollars. So up to this point, we've been playing purely in functional currency. I made the heroic assumption to eliminate that calculation, but now we're stating things in functional currency and US dollars. And because you're going to be taking these US dollars over to other forms and starting to calculate tax liability. And the other form that you're going to take it to is our friend Form 8992, which is the place where you actually calculate the Global Intangible Low-Taxed Income. So if you want to think about it this way, you can think of the Schedule I-1 from Form 5471 as kind of the engine that collects all the data from Form 5471 and where it's sort of identified in chunks that are useful to come over to Form 8992 and then compute global intangible low-tax income that's going to drop on the taxpayer's income tax return. Now, we have the gratuitous nudity part of the whole scheme, this net deemed tangible income return. This is an artificial tax deduction that was added to the law in 2017. And here's the logic. Section 951 Cap A was really aimed at the Apples and the Googles of the world that set up clever tax structures here, there, and everywhere using Ireland or other countries, and putting intangible assets, patents, copyrights, trademarks, and whatnot, and using these as a way to trap income offshore and not repatriate it to the United States. And under the old rules, you could have a CFC, and as long as you played the game right and you didn't pay yourself a dividend or you didn't invest the CFC's income in US assets, the net profits of the CFC would be deferred indefinitely, which was the game. And so Apple had hundreds of billions offshore, didn't bring it back to the United States. And the government here said, oh, we want you to invest more capital in US business activities, and therefore we're going to change the rules so you can no longer sort of trap profits offshore, foreign source profits offshore, and choose when or when not to pay US income tax on them. And so that's the whole purpose. And the adjective intangible in global intangible low-taxed income gives you a clue about the excuse they were using to create active business profits as a practical matter, as a flow-through, under the guise of saying, well, we're just attacking these phony baloney structures that are just using intangible assets. It's not really real business. And because it's not really real business, they said, well, here's the bone for those of you who are doing really real business. If you have tangible assets, depreciable assets, then we're going to give you some of the return on that investment tax-free. And they arbitrarily said 10%. So, and they take the adjusted basis of your tangible assets and give you 10% of that. And you don't have to pay US income tax on it. Yay. So you look at the economic incentive here. You have an economic disincentive to park your patents and copyrights and other intangible assets offshore as a tax-saving methodology, but you have an economic incentive to pour billions and billions and billions of dollars into building factories outside the United States, because you can thereby prevent some US income tax liability. So this is the hidden benefit of congressional thinking. It's a lack of second order, analysis. If we do X, what will happen after we do X? Well, there you go. Anyway, that's why this exists. It exists to reward CFCs that have tangible assets, depreciable assets, and tax CFCs that have any kind of profit that's not directly related to income generated because of those tangible assets. The other thing to remember here is that the code arbitrarily has a 10% return on tangible assets, which kind of tells you what Uncle Sam thinks is a fair return on investment for you. So, not that that's Marxist or anything, but so let's talk about this. In a sense, this is not unlike the idea of depreciation. You're going to be looking at an asset on the balance sheet. You're going to be doing some math according to some formulas that the Internal Revenue Code gives you, and you're going to end up with a number that is a deduction that you're going to use in computing your taxable income. So same idea. This is just an arbitrary thing it's not really attached to the expected economic failure of a particular asset. You know, this machine is going to die and have to be replaced in 7 years, so we're going to let you write it off after over 7 years because we expect the asset to be worth zero at the end of that. This is just an arbitrary thing. Frankly, I think it's a cookie that they gave us in 2017 so that everybody would swallow their medicine. And here's the big picture method. And for me, this deemed tangible income return, investment return, is the most complex piece of the whole puzzle. And you can see part of it's in gray and part of it's in blue. And so this shows you the interaction between the pieces that are called, that are related to interest expense, and they're all in blue, and the gray part, which is kind of all of the asset and depreciation and all that fun stuff calculation, or the simple subtractions. So you can see we start at the top with interest expense. And the big picture here is the government did not want to inadvertently create an incentive for the CFC to go hog wild on borrowing a lot of money, generating a lot of interest expense, and then by doing so, goosing the amount of depreciable assets that they could have, which would goose the tax deduction, which would reduce the income tax liability for the taxpayer. So the methodology is very complicated, but the basic idea here is they want to prevent abuse of excess debt financing. And so we're going to follow this all the way through the forms. And again, if a whole hour on net DTIR is what you're craving, and you'd be willing to watch that on a Saturday night with a glass of wine while you're sitting on the couch at home, because it's that interesting to you, let me know. So we're going to start here with this acronym QBAI, Qualified Business Asset Investment. So these are all your depreciable assets. And you're going to see there's a lot of jargony words and defined phrases and acronyms here, and it gets really confusing. So but the idea is you've got depreciable assets, and you have to compute the adjusted basis for the assets. And again, they didn't want you to be playing a funny game like buying a very expensive machine, a depreciable asset, on December 30, and thereby claiming a huge deduction for the whole year. So there's a quarterly calculation of adjusted basis, and then you take the average in order to compute this specific number that you need to calculate for Global Intangible Low-Taxed Income purposes. So it's a little bit more complicated than your average depreciation calculation, but not bad. I mean, it's just you have to remember this quarterly thing and then use the average. So, for instance, when you look at Schedule F of Form 5471 in the example tax return I gave you, you'll see that there's a $19,000 of depreciable assets, and we assumed $2,000 of assets in the current year. And so you just do simple head math, and you just say, well, if you spread that over the whole year equally, QBAI is $18,000. And so, hey, magic, You know, line 8 is where QBAI comes in. So this, again, remember, this is, up to this line, we have been talking about income statement, and now we're switching over to balance sheet calculations. And the slide deck that you got as a PDF has a mistake on this page. It says 20,000 of depreciable assets instead of 19. So after this presentation, or sometime during, we're going to be sending out the corrected slide deck. So please throw away the old one and use the new one. One of these days, I'll actually get through a whole slide deck with no accidental typos, which will be just killer. So anyway, so this is where it comes. This is not a hard calculation. This is just a little bit more busy work for you. Now, we've got $18,000 of QBAI. So this is the depreciable assets, the adjusted basis of depreciable assets calculated in a quarterly fashion. You see on line 2 here where the arrow is pointing, it says multiply that number by 10%, and we have a $1,800 number. Okay, so that is the sort of the tentative deemed tangible income return. So if nothing else was happening here, we would have an income inclusion for our taxpayer of $17,000 of tested income, net tested income, minus the $1,800, so it would be $15,200 of gross income inclusion on Form 1040. But that's not the whole story. You see on line 3, we've got this $1,000 of interest income. And this is where things get a little bit complicated and a little bit weird, because we have $1,000 of really truly interest expense paid to some random third-party lender. But you can see that on line 4, that the actual net DTIR, the actual tax deduction allowable to the shareholder, is only $800. So somehow this $1,000 of interest expense has negated a portion of this cookie that Congress gave us in the name of DTIR, deemed tangible income return, and somehow you only get half a cookie. And the thing that's happening here is you're deducting part of the interest expense. And again, this is a whole, an hour if this is important to you. And for any kind of significant sized CFC that has a lot of borrowing going on, it is. And in fact, if you have a CFC that has a lot of borrowing and it also holds income producing debt obligations, right? Loans receivable. It's interest income and interest expense. There's a netting function that's going on that I've heroically eliminated from the example because, again, it would make the 1 hour that we're talking here a little bit too long. So you're going to be deducting this thing called specified interest expense in order to arrive at that red number, which is the magic number that we really, really care about. And that was the 800 on the previous page. And again, referencing the jargony defined phrases, we are going from qualified interest expense to tested interest expense to specified interest expense. So 3 different definitions of the types of interest that you have to work with in order to calculate true taxable global intangible low-taxed income for your taxpayer. And again, this is a giant mess, but I will give you my best shot at the 2-minute overview, and we can spend some quality time together if you want more detail in some other time. Oops, went there. So here we go on Schedule I-1. You see on line 9A, we have interest expense, 1,000. And then we have the line 9B, and that's the interest expense that the CFC really truly paid. Then we have line B, which is qualified interest expense. And qualified interest expense is designed, it's a calculation of interest expense that is designed to somehow offset the fun and games that taxpayers use to borrow a lot of money, park it here and there, so and thereby, artificially, I don't know what to say, create way too much interest expense, and so potentially giving the CFC a double tax benefit of legitimately reducing gross income by interest expense, and artificially inflating that net DTIR number through obscure mechanisms in the regulations. And I'm sorry for hand waving over that, because it becomes important to you if that is here. But the idea here is you're going to take the interest expense and multiply it by a fraction. And the first one is interest expense on what they call qualified assets. That's the numerator, and the denominator is all interest expense on all assets. So in the example I have here, God, this is, if I was listening to this, I'd be cursing myself right now, because this is so complicated and important. Only if it matters. If you don't have any debt, it doesn't matter. So, you know what? After this, I'm going to send you a link to a blog post I have on the blog that explains this stuff, and it'll help, I hope, and my apologies. Anyway, in my example, we've got 9B, the qualified interest expense, which is a weird calculation, is 0, which means that the tested interest expense is going to be the same $1,000. And here we go then back to Form 8992, where you port that $1,000 over from where we just were on Schedule I-1, and we stick it there, and it becomes an offset to the line 2, resulting in net DTIR of $800. And here you can see the result of the subtraction. So again, a long involved calculation. In my experience, you got to do a lot of stuff by hand. And at the end, you end up with a number net of some or all of your interest expense as the actual allowable net DTIR, which reduces your global intangible low-taxed income. And so finally, we come, thank God, to the exclusion amount. And the exclusion amount, inclusion amount. So we have taken tested income, we have subtracted this artificial number, which is the baseline, based on the hard assets of the CFC, and we've come to the number that's actually defined as global intangible low-taxed income. And that's the bottom line, line 5 here on Form 8992. And that's the number that you port over to the income tax return, straight over. There is a second deduction that is given to some taxpayers. So now you'll see on the income tax return example that you got, there's a $16,200 number on Schedule 1 of Form 1040, and which ports over to page 1 of Form 1040, and you'll see it there, which then trickles through, and the actual tax liability is calculated for our mythical taxpayer. This particular deduction is a second kind of deduction that the government gave away as part of the whole package in 2017. And the Section 250 deduction is an artificial deduction that will sunset over time. that just arbitrarily reduces global intangible low-taxed income inclusion for a U.S. shareholder. And this is on Form 8993. And I haven't filled it in because I wanted to highlight an important point. But the idea here, before we talk about the important point, is what is this Section 250 deduction? The answer is it's a very simple number. It's 50% of whatever your global intangible low-taxed income inclusion is. So your global intangible low-taxed income inclusion of 16,200 has an offsetting deduction under Section 250 of 8,100, which means your gross income inclusion that's going to trickle through your taxable tax return until it hits taxable income and you calculate tax liability is only going to be 8,100, which is awesome. Here's the problem. The only taxpayers that can take the Internal Revenue Code Section 250 deduction are domestic C corporations. So if you have a domestic C corporation that owns 100% of the stock of a controlled foreign corporation, no problem. The deduction is allowable. So in that case, $16,200 inclusion, $8,100 deduction, net taxable income, $8,100 on Form 1120, 21% tax rate. Tax liability is functionally 10.5% of this inclusion instead of 21%. So this is awesome. So domestic C corporations can do it. Individuals, if individuals make the Section 962 election, they can use the Section 250 deduction. The Section 962 election in broad strokes just says that I'm an individual, and on these specific categories of income, Subpart F income and global intangible low-taxed income, I elect to be treated using Subchapter C. So the income is taxed at 21%. You get all of the deductions allowable under Subchapter C. Foreign tax credit rules that apply to domestic corporations apply in this context, blah, blah, blah. So these two types of people, what's missing? Just regular individuals who don't make the Section 962 election. So in the example that I have given in the tax return attached, this person does not get the Section 250 deduction. What that means is they're going to pay income tax at ordinary rates on that $16,200 inclusion of global intangible low-taxed income on the Form 1040, which pushes for one of two things to happen. One is think carefully about doing a little quickie tax-free corporate reorg and slotting a domestic parent on top of this controlled foreign corporation, and that might be useful. The second idea is to look at the math for doing a Section 962 election for the income flowing through this controlled foreign corporation, and that might be an interesting result too. And as a general principle, if this CFC is in a quotes normal close quotes kind of country that has normal corporate tax and tax rates, it might work very well indeed, because the foreign tax credit rules for direct and indirect foreign tax credit will largely or completely eliminate the shareholders' income tax liability if you don't want to put a parent company on top of it. So there we are. Final conclusion. Bullet point number 1. We've got Subpart F income, which we've known and loved forever. Now we have global intangible low-taxed income, bullet point number 2, that makes most of a CFC's active business income taxable, which means that functionally it's as close to a pass-through as you can get with a lot of extra messiness on the income tax return. And I would encourage you to think about looking at what would happen if you have Instead of CFCs, you have disregarded entities or you have foreign partnerships. I think you might be interested in the results that you get for the taxpayer. And the brain damage that you incur as a return preparer might be significantly lower. And the final one I just want to give you is, you'll notice that I never use the acronym, not even once. And there's a reason for that. And the reason is mindset. If you keep saying that acronym in your head, attaching it to the company, the this, the that, your head is going to be silently brainwashing yourself with that word, which that acronym sounds disgustingly like a word that is unpleasant to attach to yourself as an attribute. So I'd encourage you not to self-brainwash yourself and call it 951 Cap A income, or call it Global Intangible Low-Taxed Income. And when you talk to the revenue agent on the phone, be very slow and methodical and do that and drive them crazy. And with that, we are at 56 minutes. There's the routine disclaimer, and there's my contact information. Ping me emails if you have any questions. Tell me where to go in depth. Tell me where I went off the rails here. And I appreciate it, and have a happy weekend. Bye, everyone.